So this is CA Sanidhya Saraf, your friend, mentor and coach for audit and law. So on the request of students across the country and especially on the request of my South Indian students, right? I have also come up with revision videos for English for your upcoming examinations. And in this particular video, we are going to revise CARO 2020, which is very, very important chapter in your subject, right? Now this particular chapter, CARO 2020, this particular chapter is applicable for your November 23 examinations, as well as the same chapter is also applicable in your new syllabus in the May 24 and November 24 examinations. So this video is going to be relevant for all the categories of students, the students who are going to give examinations in November 23 or the students who are going to opt the new scheme and going to give examination in May 24 or November 24. This video is relevant for all of you. This video is relevant for the CA final students, as well as this video is relevant for the CA inter students, because again CARO 2020 is a topic that exists in the inter syllabus as well as in the CA final syllabus, right? So I'm not going to take much of your time, and we are going to revise the chapter shortly within a span of half hour, and the PDF of the chapter you can download from the Google Drive link available in the description. Now CARO 2020, again it's a short chapter that is going to carry a weightage of 4 to 8 marks. The question can be direct, indirect, it can be in the form of case study, MCQ, or maybe it can be just in the form of reference based. But it is surely going to give you a weightage of 4 to 8 marks, right? Now, do remember the main objective of the auditor is to report on the financial statements. And as per 143 subsection 3, the auditor has to report on several matters. So 143 subsection 3 deals with matters to be included in the auditor's report. But apart from the reporting that is given under 143 subsection 3, there is also an additional reporting that is given under 143 subsection 11. So basically section 143 subsection 11 gives the power to the central government to specify additional reporting matters for the auditors. And using the powers given under 143 subsection 11, what central government has done is central government has prescribed additional reporting matters for the auditor, and that is what we call as CARO 2020. Now basically if we talk about CARO 2020, so there are two things to be learned and remembered in this very chapter. One is applicability of CARO 2020, that are which companies CARO 2020 is applicable to which companies. Because as a stat auditor, if I am the auditor of a small company, I don't have to report under CARO. Only if I am the auditor of a big company, only then I have to report under CARO. And the second thing is that if CARO is applicable, what are the clauses about which I have to report? So in total, there are 21 clauses. As a stat auditor of the company, I have to report regarding 21 clauses in CARO 20 if CARO is applicable. And the reporting shall be done whether the reporting is favorable or the reporting is unfavorable. In both circumstances, reporting is to be done. So I believe it is very, very clear. Now in this particular chapter, we have 4 paras, basically para 1, para 2, para 3, para 4. Para 1 talks about the applicability of CARO. Para 2 talks about auditors report to certain matters. Para 3 is the most important one. What are the matters we have to report? So all the 21 clauses that we study will come under para 3. And para 4 is basically we have to give reason for the favorable / unfavorable comment. We have to give reason for every clause. The comment that we are giving against every clause, we have to give the reason for that. Right? So 143 subsection 3 is the main reporting for the auditor, and 143 subsection 11 is basically the additional reporting that the stat auditor has to do, and that is prescribed by the central government. Now talking about the first part of the chapter, applicability of CARO 2020. One more thing guys, do like the video. Do like the video, do share the video, do subscribe the channel so that I stay motivated that okay, you guys are following the video. You guys are liking the video. So that will, motivate me further to make such kind of more videos for you all. So applicability of CARO 2020. So firstly, what the lawmaker has said, CARO 20 is applicable to all companies, including foreign companies. Oh my God, CARO 20 is applicable to all companies. Yes, sir. But how is that possible? We want certain exemptions. So lawmaker told that, okay, take certain exemptions. Now there are certain exemptions from CARO 2020. CARO 2020 is not applicable to, do remember, CARO 20 is not applicable to SBI, which has a branch code 08. Plus certain private companies. It is not applicable to SBI, which has a branch code O8 plus certain private companies. What is SBI O8? S stands for small company defined under section 2 clause 85. B stands for banking company that is incorporated under the Banking Regulation Act 1949. I stands for insurance companies under the Insurance Act 1938. O stands for one person company that is defined under section 2 clause 62 of Companies Act 2013. 8 means the section 8 companies, that is the non-for-profit organizations. So these are the 5 organizations which are exempted from the CARO 20 reporting. Small company defined under section 2 clause 85. If we go inside the definition of small company, then small company means a company other than a public company where the paid up share capital does not exceed 4 CR and the turnover does not exceed 40 CR. What I'm telling you, small company means a company which is not a public company. It's very general, it's very logical. How can a public company be a small company? So small company means a company other than a public company where the paid up share capital does not exceed 4 CR and the turnover does not exceed 40 CR. So these are the 2 cumulative conditions that we need to satisfy. At the same time, there are a few companies which are not small companies, like a holding company. It is not a small company because it is the holding, it is the father, it is a fatherly figure, so it cannot be small. We have subsidiary companies, they are not small companies because it is a subsidiary, it has the support of the holding. Section 8 companies, not for profitable organizations. They already get several benefits under law and being a small company, they will claim more benefits. So no, they cannot be small company. Then any company or body corporate that is governed by a special act. So any company or body corporate that is governed by a special act, so you have that special act for you and that special act will decide whatever sort of reporting is needed. So you are exempted. So these are small companies. Companies other than public companies, paid up share capital does not exceed 4 CR, turnover does not exceed 40 CR, the holding company, small section 8 company, subsidiary company, any company or body corporate governed by special act, they cannot be small company. Apart from that, there are certain private limited companies which are exempted from the requirement of CARO 2020. So what are those private limited companies that are exempted from the requirement of CARO 2020? So basically a private limited company needs to satisfy 4 conditions, and if it satisfies 4 conditions, then CARO 20 shall not be applicable to those private companies. And these are 4 cumulative conditions. It means the private limited companies has to satisfy each one of them. The first condition, that private limited company shall not be a subsidiary or holding of public company. So it should not be connected to that holding. It should not be a subsidiary or holding of that public company. It should not be connected to that public company. So public company, CARO is always applicable. Any company connected to that public company, CARO is always applicable. Private company needs exemption. You should not be a subsidiary or holding of public company. Apart from that, the second condition, we have to check the threshold limits. Three threshold limits. Paid up share capital and reserves and surplus shall not be more than 1 CR on the balance sheet date. So what we are going to see is that the aggregate of paid up share capital and reserves and surplus shall not be more than 1 CR on the balance sheet date. So if we talk about equity share capital, we talk about preference share capital, we talk about capital reserves, we talk about revenue reserves, all sort of things will come. Right? And the aggregate shall not exceed 1 CR on the balance sheet date. So 2 conditions we have seen. The third condition. Now we have to see the total borrowings taken by the company. The total borrowings that the private company has taken, that should not exceed 1 CR from any bank or financial institution at any point of time during the financial year. Now see the wordings. At any point of time during the financial year. Be careful about the wordings. Right. So the total borrowing shall not exceed 1 CR from any bank or financial institution, and that shall be at any point of time during the financial year. And the fourth condition, it's about revenue, which does not have a total revenue as disclosed in Schedule 3 exceeding 10 CR during the financial year as per the financial statements. We have used the word revenue and not turnover. Be very careful, because when we talk about turnover, that means only the direct business sales. But when we talk about revenue, it is a very broad figure. It includes the turnover, plus it also includes the other kinds of income like sale of scrap, like the revenue from discontinuing operations, etc., etc. So it's a very broad term. So if a private limited company fulfills all these 4 conditions, CARO 20 is not applicable to such private limited companies as well. There are some guidance notes, some important points to be remembered while studying applicability of CARO, so you can just read them once. Like this order is an order on the auditors of the company. It is not applicable to the audit report of a CFS. So branch by branch we have to examine CARO is applicable or not. It is not applicable to the audit report of CFS. NBFCs are not exempted from the applicability of CARO. How to compute the paid up share capital, how to compute the borrowing. So all those things is given. How to compute the total revenue. So you can just go through them. Now the most important thing, the matters to be included in the auditor's report, and there are total 21 clauses. We have to remember all of them, and I will help you remember each of the clauses. You will be learning the clauses by heart. You will be remembering them forever, right? Now it's very simple. Do understand the logic. First of all, we will think about asset, then we will think about liability. First of all, we will think about asset, then we will think about liability. So the first two clauses, they talk about assets. Go to the asset side. Firstly, what you visualize? Fixed asset. Then what you visualize? Inventory. So the first clause is regarding the fixed asset. Basically, the terminology we use is PPE, property, plant and equipment. So clause number 1 is regarding the property, plant and equipment. Clause number 2 is regarding the inventory. After that, we come to the loans. So clause number 3 is regarding the loans if the company has given. Clause number 4 is also regarding the loans, but that is particularly with regard to loans given to the directors. 2 clauses asset, 2 clauses liability. Then we'll be talking about public deposit. Okay, we need fund from the public deposit. And after that, we'll see the sequence. So clause number 1, PPE, property, plant and equipment. Now in this, the auditor needs to verify 5 things. Firstly, just imagine logically, I'm the statutory auditor of the company. I need to go and verify the PPE. So what at all I'm going to verify? I'm going to check the records, whether the records are proper. And the records I'm going to check, that is with respect to tangible assets as well as intangible assets, because both are equally important for me. I'm not going to be biased that, okay, I need to check only the tangible assets, I'm going to omit the intangible assets. No, I need to report on both. Whether the proper records of tangible assets plus intangible assets, both are properly maintained. Then I need to ensure the existence of PPE. That company has shown so much of PPE in the balance sheet, but whether that reality exists. For the existence, what I need to do is, I need to ensure whether physical verification is done on a regular basis by the management. And on the physical verification, whether any material discrepancies are there, whether any discrepancies are there, and whether those discrepancies are properly dealt with. Thirdly, I am concerned with immovable properties. Because the immovable properties are very material. It's a very material PPE for any kind of entity. I am going to be particularly concerned whether the title deed of immovable property is registered in the name of my client or not. If it is not registered in the name of my client, I need to report that in whose name that particular title deed is registered, whether it's registered in the name of promoter, director, any other employee, what's the reason for that. From how much time that particular person is holding the property, I need to report all of that. Fourthly, I have to report if the PPE is revalued during the year. If the PPE is revalued during the year, in that particular situation, if there is a minor change in the valuation of PPE, I don't need to report. But if the change is material, and that is greater than equal to 10% of aggregate of net carrying value of each class of PPE, that is greater than equal to 10% of aggregate of net carrying value of each class of PPE, I need to report. And fifth is, I need to report whether the company is not holding any Benami property and the Benami Transaction Act 1988 is not initiated. So that is something I have to report. I believe you understand what is Benami, what is Benami property. That is, company has told what the company is doing is company is not holding the property by its name, and maybe someone else is holding the property on the name of the company, or maybe they have created a fictitious entity, they have created a fictitious identity, and that fictitious identity is holding a property or something like that. So that is the Benami law, that is the Benami property. So 5 things in PPE we have to check. If we talk about the second clause, inventory, so inventory only 2 clauses. Right. One is existence. I need to ensure the existence. That is the most important thing with regard to inventory. For that, I need to ensure physical verification, regular intervals. Again, here I have to check material discrepancy. Now here, what is material discrepancy? The lawmaker has defined, ICI has defined that if there is a material discrepancy of more than 10%, that is the material discrepancy. So as an auditor, I will see whether physical verification is being conducted on a regular basis by the management, and whether any material discrepancy is there, and if discrepancy is more than 10%, whether that is properly dealt with the books of accounts or not. Here I can also say that as a 501 comes into picture, because that also talks about verifying the physical verification. Right. Secondly, what normally practically company does is that they avail working capital limits against their inventory. So that we have so much of inventory, so grant us a working capital limit, and the financial institutions easily grant a working capital limit on the basis of inventory, and the companies are required to file a quarterly statement regarding the inventory position they hold. So as an auditor, I need to report if the working capital limit is sanctioned, that is sanctioned is more than 5 CR. Whether the company is properly filing the returns or not, and the details given are proper or not. So that is what I have to report as an auditor. So in inventory, again, there are two clauses. Do remember, inventory is not connected with AS2. AS2 is a different line game. AS2 is a different ball game altogether. That talks about valuation of inventory. Similarly, in AS2 talks about valuation of inventory. And in clause 2, we don't have any connection with AS2 or in AS2. Then we have clause number 3. So this particular clause number 3, I call it as the Ijazla clause. What I call it? Ijazla clause. What is Ijazla clause? So I stands for investment, G stands for guarantee, S stands for security, L stands for loan, A stands for advances. So basically that Ijazla gives you a brief about this clause, that okay, company is given making any form of investment, company is giving any kind of guarantee, company is giving any form of security, company is giving any kind of loans or advances, something like that. Now this loans, this securities, this advances, anything that can be given to group companies, that is the related parties, as well as other than group companies. Both are possible. Okay. So now when we talk about group companies, basically what I call is group companies SJA, SAJA, subsidiary joint venture associates. Subsidiary joint venture associates. So basically Ijazla, that is regard to group companies or other than group companies, right? Now some common things that I have to consider, I have to report whether it's regard given to group companies or it's given to other than group companies, that terms and conditions, whether they are not prejudicial. The schedule of repayment of principal and interest, whether that is properly specified. And if the money is overdue, then any company will try to recover the money, na? So if the amount is overdue and the total amount due is more than 90 days, whether reasonable steps are taken for recovery, that boss, more than 90 days. Almost it's an NPA. So are you taking any reasonable steps for recovery? What are the reasonable steps you are taking for recovery? So this is one major particular thing that you need to report in clause 3. Then what we have to report? Suppose company has given some kind of loan, some kind of advances, and the repayment is due from those persons, from those directors. Right? Now the repayment is due. So basically the company is waiting. Let the funds come. But company, instead of closing the loan, they are renewing the loan. They are extending the loan. They are granting fresh loan against the old loans. So as an auditor, I need to specify in percentage that out of the total repayment due, out of the total loans given, what is the percentage of the loans renewed or extended or the fresh loan that is given. I need to report as an auditor so that the users of financial statement can know about it. The next particular aspect of this very clause is, suppose if the company has given any kind of demand loans to promoters or related party. What are demand loans? Where the term and repayment period is not specified at all. So the company has given some kind of demand loans to promoters or related parties. So maybe some kind of related party transaction is involved. Maybe some kind of favor is given to promoters or related parties. So we need to report, we need to specify in percentage that out of the total loans, how much percentage of loans is given to promoters or related party. Those are demand loans. So that is what I have to report about it. So I believe it is clear. So these are the things that you need to report in the Ijazla clause. If you refer in your book, there are 6 clauses. I have divided that into 3 clauses. So in clause 3, if you see your book, there are 6 clauses. I have made it short and I have divided into 3 clauses for your better understanding, for your better retention. The next clause, clause number 4, I told that's also about loans. But this is about loans given to directors. This is about investment made in any other companies. So you must have got that hint. Okay, sir, loans given to directors means you are talking about section 185. Investment made in any other companies means you are talking about section 186. Yes, you are right. I am talking about section 185 and 186. So if company has given any kind of loans to directors, if company has given any kind of loans to the connected person of a director, I need to ensure whether provision of 185 is complied or not. Similarly, if company has made investments in any other company, company has given advances to any other company, company has given loans to any other company, I need to ensure whether provision of section 186 is complied or not, and I need to report in CARO. And if they are not complied, then I will modify the report as per SS 705. Now I'm not going to discuss what is there in section 185, what is there in section 186. That is the part you discuss in company law, you study in company law. The next clause. Now do remember, 2 clauses with respect to asset, 2 clauses with respect to loan. Now what the company is doing, now the company needs money. So from where they will get the money? They will get the money from the public. So what are the various forms of money, how they can raise money from the public? It can be via public deposit, it can be via loans, it can be via IPO, it can be via FPO, it can be via preferential allotment. So clause 5 is talking about company raising the money from public via public deposits. Similarly, companies raising money via loans, that is clause 9. Similarly, if you see company is raising funds via IPO, FPO, preferential allotment, that is clause 10. So public deposit, clause number 5. Now if the company is taking deposits, public deposits, it means chapter number 5 of Companies Act 2013 is applicable here, that governs about public deposits. Section 73 to 76 and 76A. That gives the various conditions, who can accept public deposit, who are the eligible companies they can accept public deposit, what is the limit, what are the conditions, all those things. So as the auditor, I need to report that if the company has taken public deposits or the deemed public deposits, whether provisions of section 73 to 76 and 76A is being complied with, whether all the RBI circulars, NCLT circulars, NCLT orders, whether they are being complied with. That's it. Then clause number 6, it's about cost records. It's about cost records. Now if you remember, section 148 of Companies Act 2013 read with the cost records rules 2014. So section 148 says every company, whether it's a regulated sector or a non-regulated sector, if the overall turnover is greater than equal to 35 CR in the immediately preceding financial year, they have to maintain cost records. Right? In regulated sectors, there were 6 sectors: petroleum, telecommunication, fertilizers, medicines, sugar, industrial alcohol. In total, there were 6 sectors. Electricity. So whether it's a regulated sector or it's a non-regulated sector, if the overall turnover is greater than equal to 35 CR in the immediately preceding financial year, the company needs to maintain cost records. And clause 6 of CARO says that I need to report whether the company has maintained cost records as per the requirement of section 148, if at all the requirement of section 148 is applicable. Is it clear? Okay. Sir, it is very, very clear. So clause number 1 to clause number 5. Right. Now clause number 7, that talks about statutory dues. What are statutory dues? Statutory dues means those dues that the company has to pay. It is mandatory. It is as per law. Now those dues can be with respect to government or employees. What are the government related statutory dues? Can you just tell me? Sir, it can be income tax, it can be GST, it can be custom. So all the different sorts of taxes. Right. If we talk about employee related dues, sir, it can be provident fund, it can be GST, it can be gratuity, superannuation funds, all those different things. So these are the statutory dues that the company is legally supposed to pay to the government or employees. Now clause 7 talks about reporting of statutory dues, whether it's towards the government or employees, and that is further categorized into undisputed statutory dues and disputed statutory dues. What are undisputed statutory dues? That the company itself is admitting this much I have to pay. I don't dispute. I agree. This is what we have to pay. And what are disputed statutory dues? That there is a dispute. We don't agree to the demand raised by the government. Right. So undisputed statutory dues. So now this is something you admit now that we have to pay. So whether that you are paying regularly, that I have to report as an auditor. And if the arrear is more than 6 months, I have to report separately. Right. And if the statutory dues are disputed, then what is the dispute? With whom there is a dispute? Regarding what there is a dispute? At which forum there is a dispute? I have to report those things. Now do remember one more thing. If there is a dispute, it means company may have to pay that additional amount in the future. So logically company should make that provision for contingent liability, and that is the requirement given in AS 29 and AS 37. So the correlation is there with AS 29 and AS 37 as well. I need to report whether provision for contingent liability is made as per AS 29 and AS 37 in there. If that is not made, I need to modify. And at the same time, this particular clause also has a correlation with Asset 250, consideration of laws and regulation in an audit of financial statements. Clause number 8 talks about unrecorded income. So basically, sometimes what happens is that the entities do not record income in the books of accounts. But later on, near the income tax department, they surrender. Because government has brought a scheme that, okay, you surrender now and will not charge any penalty or something like that. So the SSC feels that, if the department catches me, then I will have to pay heavy penalty. But now if I surrender, I don't have to pay any penalty. So if there are certain kind of unrecorded incomes, as an auditor, I have to report. Clause number 9. Now this is a very, very important clause. It talks about any kind of loan that the entity has taken and they have made a default. Right. So this particular clause is I can say it's a gift of Nirav Mehta. It's a gift of Vijay Mallya. For them, this clause has come into picture. That company has taken loan from any lender and made a default. So whether company has taken loan from any of the lender and made a default, I need to report as an auditor, and the format is given below. Apart from that, if the company is being declared a willful defaulter by the bank or financial institution, that I have to report. Apart from that, regarding the term loans, I have to report. Regarding the short-term loans, I have to report. That if the term loans are taken, whether they are used in the same purpose for which they were actually obtained. Whether the funds are not diversified and used for some other purpose. If the funds are being raised for short term, whether they are not used for long term purposes, because that may actually impact the going concern of the entity that you wanted for that you raised funds on short term, but you are using it on a long term project. How will you repay the funds after the short term? And finally, whether the funds are taken to meet the obligations of its group companies, joint venture subsidiaries, associates, that you have taken funds from the market, that is to meet the obligation of your children, joint venture subsidiary associates. Or you have raised the loans pledging the securities you have in your group companies. That is joint venture subsidiaries associates. So these are the things that is going to come in clause number 9. That is default in any kind of loan, whether the company is declared as a willful defaulter, whether the term loans that were raised are applied for the same purpose, because if not, that is a kind of fraud that is governed under as a 240, whether the funds raised on short term have been utilized for long term, because if that's not the case, as a 570 can come into picture, the going concern can be in danger, and whether the company has taken funds from any entity or person to meet obligations of JSA, joint venture subsidiary associates. Then we have clause number 10. I told you different forms of raising the money. One can be by way of loan, clause number 9. One can be by public deposit, clause number 5. And it can be by IPO, FPO, preferential allotment, private placement. So all those different modes. So clause number 10 talks about all those different modes. That if the company has raised money from the general public by way of IPO or FPO, I need to report whether it is utilized in the same purpose. If the company has raised the money by way of private placement, by privately circulating the document among the members that we want certain kind of money, and that is a private placement only from the family's friends or relatives. So in that particular situation, section 42 is applicable. If the company has made any kind of right issue, section 62 is applicable. So section 42 and section 62 lays down the conditions for private placement, right issue, etc. So if the company has made any kind of preferential allotment or private placement, whether section 42 and section 62 of the Companies Act is being complied with, that is what I have to report. Now, can you imagine that everything what the company is doing, basically they are doing a fraud? So clause number 11 talks about fraud reporting. Right. Now it has a deep correlation with SA 240. It has a deep correlation with section 143 subsection 12 of the Companies Act. Because 143 subsection 12 also talked about fraud reporting, where the auditor needs to report the fraud to the CG. SA 240 also talks about fraud reporting. Only the difference here is that CARO reporting is a broad reporting. It covers fraud by the company or fraud on the company. So that's a broad reporting. And apart from this, if there is a 143 subsection 12 reporting, that will also be covered here. I also have to report whether I have reported under 143 subsection 12. And the new addition, the new hot addition in CARO 20, the auditor needs to report whether they have considered whistleblower complaints, if any, received during the year. So who are whistleblowers? The insiders of the company who reveal certain information about the company that helps us in catching frauds or certain things like that. So as an auditor, I need to consider the whistleblower complaints at least. I need to, accordingly perform my audit procedures. I cannot simply ignore it. So as an auditor, I need to report whether the auditor has considered whistleblower complaints, if any, received during the year. Now do remember clause number 12, clause number 16. These two clauses are particularly with regard to special companies. Clause number 12 talks about Nidhi companies in particular. Clause number 16 talks about NBFCs in particular. So if I'm doing the audit of Nidhi companies, only then clause 12 will be applicable. And if I'm doing the audit of NBFCs, only then clause 16 will be applicable. Right? So clause number 12, 16 will be doing together. So regarding Nidhi companies, what we have to report is, so Nidhi companies are required to maintain a certain ratio as per the Nidhi rules. That is, net on fund is to deposit should be in the ratio 1:20. Apart from that, the Nidhi company is required to maintain at least 10% unencumbered term deposits out of the total deposits as per the Nidhi rules. What are unencumbered term deposits? Deposits which are free from any kind of mortgage or pledge. So out of the total deposit, they need to maintain at least 10%. So as the auditor, I need to report whether they have maintained that ratio of 1:20, whether they are maintaining 10% unencumbered deposits, and whether there is any default in the payment of interest or default deposit by the Nidhi companies, whether they have not made any kind of default. Clause number 16 again particularly talks only about NBFCs, non-banking financial companies. So basically NBFCs are required to be registered with the RBI. So we need to report whether they are registered with the RBI. They need to have a valid certificate of registration. So we need to report whether they have a valid certificate of registration. And there is a specific reporting if the NBFC is a core investment company, that whether they fulfill the criteria to be a core investment company. So that I have to report. Right. So clause number 12, 16. 12 about the Nidhi companies and 16 about the NBFCs. Right. Now do remember, basically what happened is that the director of the company loves a girl called Nidhi. And who is Nidhi? She is a related party. So after Nidhi company clause, there comes the related party clause. Clause number 13. So when we talk about transactions with related parties, section 177 and 188 of Companies Act is applicable. Section 177 says obtain audit committee approval for entering any kind of related party transaction. 188 says that obtain members approval for entering related party transactions if certain threshold limits are exceeded. And also AS 18 is applicable, which talks about certain disclosure requirement with regard to related party transactions. So as an auditor, I need to report whether all the transactions with related parties are in the compliance of section 177, 178 and AS 18. Now what the internal related parties doing? Related parties doing the internal audit. So next clause is internal audit system, clause number 14. So I need to report whether the company has an internal audit system that matches with its size and nature. It's a listed entity, it does not have an internal audit system, I need to report. I need to report the compliance of section 138. And also I need to report whether the statutory auditors have considered the reports of internal auditors. Now what the internal auditors observed, they observed that a lot of non-cash transactions are being entered. So the next clause is non-cash transaction, clause number 15. So whenever the company enters into a non-cash transaction, section 192 is applicable and conditions of section 192 has to be complied. If you remember, that along with the notice of the meeting, a notice of registered valuer report is to be given, OR is to be obtained. So if the company has entered into any non-cash transaction, we need to report the compliance of section 192. The next is NBFC clause. Now do remember NBFC clause 16 means on 16th we obtained a NBFC. NBFC started generating cash losses. The auditors resigned. Going concern in danger. So NBFC clause, after that cash losses clause, after that going auditors resignation, after that going concern clause. So clause number 17 is cash losses. We need to report whether the company has incurred cash losses in the financial year, and if yes, we need to report the amount of cash loss. Clause number 18, we need to report if the auditors has resigned, if the stat auditors has resigned. Previous year there was some other auditor, they have resigned. We need to consider the objections raised by them, why they have resigned. The Chartered Accountants Act also points out that we need to communicate to the previous auditor and we need to ensure the compliance of section 139, 140. And further, CARO says that we need to report that if the auditors has resigned, whether we have considered their objections or concerns. The next clause is the going concern clause. We need to report regarding the going concern after analyzing financial ratios, after seeing the financial assets, financial liabilities, the directors report, everything. We need to report whether the going concern is valid and if at all the company's assets, whether it will be able to meet its liabilities in the next 1 year. So when going concern is danger, we think about doing good things for the society. So clause number 20, that is the CSR clause. Transfer of unspent CSR amount. So as per CSR obligation section 135, companies upon which the CSR is applicable, they need to spend to average of 2% of profits in the CSR activity. Now, what if the amount is unspent? If the amount is unspent, they need to transfer it to a certain fund given in Schedule 7. The directors cannot keep the fund in their personal bank accounts, or the company cannot keep the CSR funds in their personal bank accounts, in the company's bank account. So we have to report that in respect of projects other than ongoing projects, whether the company has transferred the unspent amount to a fund specified in Schedule 7. And if it is an ongoing project, so for ongoing projects, there is a rule that you need to transfer the fund in a special account. You need to transfer the fund in a special account for ongoing projects. So if it is an ongoing project, whether the fund has been transferred to that special account, we need to report. And finally, clause number 21 says that till now, all the 20 clauses of CARO, I was reporting regarding my company. Now I have to think about the children of my company. Who are the children of my company? The components, the subsidiaries, the associates. That if their auditor has given any negative remark in their CARO report, I need to find out. I am the auditor of Reliance, but the subsidiary of Reliance, they have pointed out a negative remark in their CARO report. I need to find out under which para they have reported, what is the negative remark they have given. So this is clause number 21. So these are the 21 clauses that you need to remember for the purpose of CARO. How can you remember all the 21 clauses? I believe a lot of clauses you must have already learned by now. Now do remember, basically what we are doing, what has happened is that company has done certain kind of irregularities and certain PIL is filed against the company. For what the PIL is, that they have taken certain deposits, they have not maintained records, they have not paid the statutory dues. So certain PIL against the company that they have taken deposits, not maintained records and not paid statutory dues. They have certain unrecorded income, they have not shown the income, they have made defaults. They have taken loan, they have done default, they have raised money from IPO, they have done default, they have raised money from FPO, they have done default, that is, they have done a fraud. And all this fraud the director of the company has done with Nidhi, who is the related party, and related party is the internal auditor, and the internal auditor has observed non-cash transaction. Till clause 15, this is the flow. Now, no other option in life. So clause 16 opened NBFC. NBFC went for cash losses. Auditors also resigned, going concern in danger. Now CSR. Clause number 21 thinking about the children of the parent company. Clear? So this is how you can remember all the 21 clauses. So again, it's an important chapter. I believe this revision video was helpful for you, and if you feel that this revision video was indeed helpful for you, don't forget to like the video, don't forget to share the video. Be open-hearted, have a big heart, like the video, share the video with hundreds of your friends, and do support us in our venture as well, right? So all the very best, love you all, take care.